Before we start, Andy, I just wanted to say a quick thank you to our podcast sponsors, Money Farm. Now, Money Farm are the largest digital wealth manager in Europe, and they create portfolios of ETFs for their clients. They're incredibly cheap and ideal for somebody who's wanting to get into investing, and perhaps for more experienced investors who don't actually want to run their own money anymore. Now, they will even offer to run the first £20,000 of any of our listeners' portfolio absolutely free if they enter the code MTTM20K into the website at moneyfarm.com. For more information, check out their website. But for now, Andy, let's get back on with the show.
Hello and welcome to episode 169 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leeks. Now, it's a slightly different show this week, and I've already slightly lied at the start of the podcast because this week we don't have your resident expert, Damien Fay. Now, listeners may be aware that last week Damien was feeling a little under the weather, and unfortunately he's not well enough to attend this week's podcast, but hopefully Damien will be back next week fully rested and raring to go. So as a special treat this week, we've looked through the archives and we picked out a piece that we believe is worthy of a second play, and that's the 2018 investment outlook. Now, Damien seemed to have his crystal ball at hand, and as Damien ever does, he's always able to come up with the insight that others can't. And Damien was able to predict the volatility that was going to happen in the markets just a few weeks before it actually happened. So Damien explains in this piece about the volatility, about yields, about the VIX, and how listeners should keep an eye on that, and that would be a really good guide as to what might happen in the markets. It's a really interesting piece. Damien comes up with lots of little tidbits and advice on what you should think about if you're thinking about investing yourself, and as I say, it's worthy of a second listen. Have a listen again this week. We're sorry it's not a full show. We'll be back to normal again, we hope, next week, and we'll see you on the other side. Damien, you wanted to talk about sort of an investment outlook. What are we talking about?
Right. This is something that is probably very relevant to this period of time. I know we try and keep things evergreen, but it's always nice to talk about something that is the investment outlook for a period of time, because people are worried, okay, Andy, that markets are at all-time highs. Does that mean we're going to have a correction? If it does, what are the likely triggers for that? Basically, everybody is trying to second-guess what's going to happen. And this crystal ball gazing idea is obviously the route to madness, but I wanted to give people a view of some of the things to look out for in 2018 when it comes to investing, because it's useful and it's to give them some value and some insight. Now, if you want to know more about this stuff, again, I do it more in 80/20 Investor, but let's just talk about one thing. People ask about predictions. Where are we going to end up at the end of 2018 versus where we were at the end of 2017? Now, 2017 was a very positive year. It was one of the best years. It's as good as it gets in terms of investing. The markets were up double digits. Pretty much every asset you could have possibly invested in, I think nearly every asset, went up. And even though it was to varying degrees, it was a year that was good to be in the market, despite the fact at the start of 2017, people were still panicking about the prospect of markets crashing. Now, to give people a bit of insight, I won't make predictions of where the market will end at 2018, but investment banks out there like to make predictions of where markets will end at the end of 2018, because in a way that's kind of what they're paid to do, because they invest people's money. Now, as a general average, they are becoming increasingly bullish, despite markets being at all-time highs, about where 2018 will end up for various different assets. And generally, they think it's going to be a pretty good year for stock markets, for example. Now, one thing I would say to people before they run off and go yeehaw and start putting all their money in the stock market, bear in mind who tells you any message that you hear. Investment banks will generally, I would argue, be more bullish. Let's be honest, if you make money from investing people's money, then you're not going to say to people, run for the hills. Don't invest. Go to cash. Cash is king. If you put money in it, you're nuts. That wouldn't go down very well with their clients. So they make money out of investing people's money and skimming something off the top. So they are always going to have a slightly more bullish outlook, I would argue. So I have to think that the people's expectations need to be a little bit more realistic. That if last year was the exception to a rule, then this year, I think if you go in with your eyes open, then there's a possibility of some form of correction. But we said that for all of last year, and the fact is we just don't know. So those who are crystal ball gazing out there, don't necessarily pay too much attention to it. There is something called confirmation bias, which means that you do tend to gravitate towards things that confirm your existing ideas or what you want the world to be like. And that is something that's human nature. We do it all the time. So you've got to try and find the opposite view to what you think. If you think the market's going to go up, you should be reading things also to give you balance about why the market could go down. Now, on that, I want to just talk about a couple of things for people to really keep an eye on in the market where things could go wrong. Now, we have geopolitics, which is the term that's widely used for anything that is a potential minefield in the political world somewhere in the world. So a good example is Donald Trump trying to cause a nuclear war with North Korea. That would be geopolitics. Those sorts of things are always going to be cropping up and popping up, and you never really know where any of these things are going to come from. We know some of them that might be out there that we're keeping an eye on, but sometimes it's the things you don't expect that suddenly pop out of the ether. And there are some elections that are going on in Europe. I think there's the Italian election this year. There are the midterms in America. These are issues that will come to the fore at some point. Now, one of the trends of last year was that the volatility in markets was extremely low. It just kept going down, kept dropping, and it hit or went near historic lows. Now, one of the things is, if you ever hear of something called the VIX, VIX, not the stuff you put on your chest when you've got a cold, but the VIX is a measure of volatility in the American stock market. Just think of it as the fear gauge of the market. If you go and Google it, you'll find it. It's a number, and it is a measure that shows how nervy people are. That's what it's generally used as, even though that's not the official reason it exists, but people look at it. And it's down below towards 9 of 10. And that is a sort of showing that markets are very calm, or you could say complacent. The average is up near 20. So when something goes wrong or people get a bit worried, it jumps. And so that's something to keep an eye on if you're wondering if the market is getting nervy, because previous stock market crashes have always been, not always, but they generally are preceded by a pickup in that level of nervousness in the markets. And so for an average investor that sits in his armchair, it's quite hard to have a measure, like a dipstick of what's going on in terms of fear. So have a look at that. And one of the other things, I'm not going to talk about all of the various things to look at. One of them I will mention is technology stocks. Now, technology stocks drove the market up in 2017, and they're called the FANGs. And that is the acronym, which in investing, they always come up with acronyms. So we had the BRICS. Do you remember? It was to do with the Brazil, Russia, India, China. They were the countries that were meant to be the lead in the emerging market rally years ago. So they bring it together. It kind of makes it easy to understand. It makes very good news headlines. The FANGs are Facebook, he's got to remember them all now, Amazon, Netflix, Google, though that's called Alphabet now. So you've got these names, they create an acronym of them, and they have been they were the stocks that took drove the market up last year. They rallied incredibly strongly. So if you're an investor, it's always worth looking at the share prices of those stocks, which you can find quite easily to see what's going on. Because one of the reasons we did a podcast, go back about 3 episodes ago, where we talked about the tech rally and what you can learn from that. So I'm not going to go on about it too much here. But one of the things it can show is whether there's been a change in the trends that are driving markets if they start to flag. Now, it leads on to this idea of inflation as well that comes into the market. Now, the market has been betting there will be no inflation coming through, and one of the things that we would hope to see at some point is some inflation coming through. Otherwise, it's a sign that the economy is probably not doing very well, or not going to do very well. And it also led into one of the reasons why the lack of inflation, as to why stocks in tech firms were doing quite well. And it was down to the fact that interest rates didn't look like they were going up. And if interest rates go up, then it means that the earnings of tech stocks, which are way off in the future, when you discount them back, don't look as good. So that's why. You go back to the previous podcast and I'll explain it in full. Now, one of the big things I want to talk about leads on from inflation, and inflation is bad for bonds. Now, that is because, again, for the interest rate reason. If inflation picks up, it means interest rates will be increased by the central banks to counter inflation. And it also means, therefore, bonds, which are effectively loans, that's what they are, even if you don't realise that, where you pay an amount of money and then you get a fixed rate of return. That fixed rate of return doesn't look very good if interest rates generally are going up. Just think of it. This isn't correct way of thinking of it, but think of it like being in a really naff bank account. When you see other interest rates going up, you'll start thinking, well, that's not great, is it? So in bonds don't do very well. And what we've got is a world where bonds are facing quite big headwinds. And in the last since the financial crisis, what's happened is central banks printed loads of money to stop the world collapsing. And what it did is it drove up stock markets. But the way they printed money wasn't necessarily to print money and flood it out there, actual paper money. What they did is make electronic money just make it out of thin air, and then they bought things like government bonds off of banks, and then therefore the money those banks had was meant to go into the wider economy and oil the wheels. Well, what it meant therefore is that there was some huge buyers of bonds and things like that in the market, and we're talking trillions of dollars and pounds worth around the world. So there's some big buyers in the market that therefore distorted that market, which is why we had yields go so low, and it's why we've had things like the VIX go low, because everyone's sort of calm. Everything's going up. The bonds and equities, historically, they're supposed to not move in tandem, but they are moving more in tandem than they ever used to. Now, the thing I want to point out to people who are listening to this podcast are going, they might go, well, I invest in equities. I don't care about bonds. I'm a stock man. Then the problem is that in 2018, it looks like we might start seeing some inflation pick up. And if we do, because we see wage growth, which is the key to getting inflation go up, because if we start getting paid more, it then becomes a vicious circle that we start wanting to buy more goods and therefore want bigger pay rises, and it causes prices in the shops to go up. But one of the other big issues is that central banks around the world who have bought all these bonds are going to start thinking, well, we're trying to normalise interest rates and raise interest rates, which is bad for bonds, so people will start selling them and don't want them anymore. But also all the bonds they've bought, they've got to do something with them. And so therefore they're going to start basically selling them or just letting them mature. But what it means is there's going to be one of the biggest buyers in the market for bonds and treasuries and gilts and things will disappear. And if that happens, then it means that the demand drops even further. And if people remember their sort of economics 101, if demand drops or something, the price drops. And therefore that means that the outlook for bonds could be pretty negative. Now, of course, people have been calling the end of the 30-year bond rally for years. Every year we seem to talk about it. It never happened. So I wouldn't place too much emphasis on the idea that it will definitely happen. But things are starting to move to make it look likely that, the headwinds are definitely there. Now, the reason this matters for stock markets is if you get a sustained, it's normally if you get a big jump. So people suddenly go, oh my God, I've got to head for the exit on bonds. Now, because of the way the market has been, where people have been buying them en masse, and central banks in particular, that when they all head for the exit, it's like if there's a fire and everyone runs for the exit and there's a very narrow exit, they all suddenly get stuck and can't get out. That's what would happen in a bond market at the moment. And people have become worried about this idea that there is going to be a problem because who's going to buy them? And so if that happens, you could get the point where the price drops a lot, and when the price drops, the yield goes up. It's just the way they're priced. They move in opposite directions. And if that happens, then it starts to make stock investors nervous. And partly because if you invest in the stock market, it's they don't like when other markets have wobbles generally. But if you think about it, if bonds are meant to be fairly safe investments, and it's some analogy I've used before, it's like being in a skyscraper and the ground shakes, there's an earthquake, then I wouldn't want to be at the top of the skyscraper, which is equity markets, and we're using bonds as the ground in that analogy. Then that's what happens. But it is also because if bond markets have a wobble, it has the knock-on effect that when the price drops, the yield goes up. Then it also means the rates in the yields and the interest rates in the economy tend to go up. And it means that the cost of borrowing for everybody goes up, whether it's mortgages or for companies. And if that happens, then that makes the economy, it's a headwind for the economy, obviously. And therefore the economy might start to stutter. And if that happens and people spend less because their mortgages are going up, then it means that company profits might go down. So I know I've chucked in a lot in there, but it's just to show you the way the thought processes work and the supposed logic works, that a bond wobble in 2018 is the one thing that people are probably might want to keep an eye on, and because it could precede a stock market crash. And there's been many instances in the past where a big wobble in the stock market, the bond market has preceded one in the bond market. Let me start that again, Andy. A wobble in the bond market has preceded a fall in the stock market, and we've seen tiny elements of this in the last few months. There was one just before Christmas. We had the bond market chuck a wobbler, and the stock market rally took a pause and dipped, and we've seen a bit of it again this year. And so I write extensively about that in actually this week's 80/20 newsletter. If people are interested, you can get a free trial. I'm not just plugging 80/20 all the time. It's just if you are intrigued, then you can go and find out a bit more about what to look for and some indicators to look at that might start to show you if bond markets are starting to go south. So that is the outlook for 2018. We're at market highs. If you keep setting market highs in stock markets, it isn't a sign of a downtrend. It's actually a sign of an uptrend, and it doesn't mean it's going to keep going. But until you see those, we see that it start to turn over and we see lower lows, then that's when you've got to start probably running for the hills if it happens. But these other markets, the volatility index, the VIX, and bond markets are going to be key in, I think, 2018. We see some stress in those areas, then maybe the stock markets will start to show stress too.
So that's it for this week. It's a short one for obvious reasons. As I say, Damien should be back fighting fit next week. If you'd like to give him some well wishes, then that's absolutely fine. If you've got a question for Damien, do get in touch. It's at Money to the Masses, and that's Money to the Masses with the number 2. Or of course you can email us always. It's damien@moneytothemasses.com. If you'd like to review the podcast, that would be fantastic. It really helps with our ratings. Go onto iTunes and submit your review there, and we'll see you next week.